Straight to really breaking news of the hour. As expected, the Fed has decided to keep its benchmark interest rates unchanged. There you go. They've actually decided to hold fire. This was more or less in line with what was being expected. What, of course, will be interesting to see are the changes that have been made to the dot plot that the Fed will really set out and give us an indication on the kind of hikes now members are seeing for the year ahead. Remember, in about half an hour from now, you will have Ms. Yellen, of course, talk about a press conference. But looks like what is being expected by the Fed is actually two hikes in 2016. Remember, in December, the Fed had said that it was looking at something like 4 hikes, but clearly that's been brought down to 2 hikes. Let's take it straight to a stellar lineup of guests that we've got for you this evening here on Smart Markets. Punita, Kumar, Sinha of Pacific Paradigm Advisors joins in. Arnab Das of Invesco, Nandini, Ramakrishnan of JP Morgan Asset Management. We've got Asianomics, Sharmila, Whelan who will join in, and so will Priya, Misra of TD Securities. All of you, thanks so much for taking time out for us. Punita, first to you. As expected, no change in rates, but I think the big takeaway is that the Fed itself now sees only 2 rate hikes this year.
So I think this is largely in line with what was expected. There was nobody anticipating a rate hike today, and everybody was expecting a hawkish tone. And so I think that this is just in line with the expectations. You have to keep in mind that while the US economy is doing relatively well, unemployment is low, CPI is rising. The rest of the world still is feeling a lot of pain, and there is serious worries about a global recession and deflationary environment across the rest of the world. So I think it's a delicate balancing act, and any sharp change in the US interest rate cycle, while that might be good for the US economy, it may not bode well for the currency markets and other emerging markets, and therefore I think one has to be a little bit cautious.
Okay. Arnab, do come in on that. I know that, going into the event, your expectation was pretty similar. But here's what I want you to react to, the fact that they actually see 2 rate hikes. Do you believe that somewhere down the course, they may actually be forced to rethink? Because from 4, we've gone down to 2. And, there's a lot being said about how we're seeing these divergent policies from central banks across the world. Because you've also got in the statement, the Fed saying that global economic developments continue to pose risk.
Yes, I think what you can characterize it as the Fed having already been forced to reconsider and relent, or at least delay, and or at least it's chosen to do that because of the spillbacks from the global economic tightening, the worries in China and the rest of emerging markets, the worries in the Eurozone spilling back into the U.S. through tighter financial conditions. So I think that's already happened a few times, and now it's happening in that. In a way, the FOMC is splitting the difference between the market pricing of the rate hiking path and the dot plot, right? So the Fed is relenting a bit here, but it's still pretty clear that the divergence is still there because they have a tightening bias, and we're talking about 2 hikes, whereas I think in the rest of most of the rest of the world, developed and many major emerging markets, including China and others, we're still talking about easing, including India, right? So the divergence is still there, but the degree of the divergence may be less than the Fed had signaled previously, yet it's a bit more than the market had originally priced.
Mm-hmm. Let's go to Nandini next. Nandini, the fact remains that these are forecasts that are also coming at a time when you've seen a pretty steady stream of decent economic data and a recovery in the financial markets, which many would argue has now bolstered the argument for a rate hike. Because, talk to anyone in, say, January, and the worry was that the US was headed for a recession and, so on and so forth. Would you say that those worries are sort of completely off the table now, and that's why we're seeing this kind of forecast today?
No, I think it's a bit short term to just say that because the past few weeks, maybe even the past 2 to 3 weeks specifically, have provided some market stability, doesn't mean that we're out of the woods entirely for the rest of the year. The Fed is certainly looking at that. You can see from the language when they did at the end of last summer, when they almost referenced directly global market turmoil, pushing back their rate hike in September. You can see that we don't have that kind of distinct reference again this time, but there is certainly a reference to global economic developments and general global slowdown. So I think that's still definitely on their mind. And while market analysts should be happy and are excited about some of the more positive action you've seen in the market for the past 3 weeks, it doesn't mean that the Fed is, having an all clear. They're looking at the macro data in the U.S. that comes out. Their dual mandate is inflation and unemployment in the U.S., and that is their primary focus.
Okay, a quick recap for all the viewers who are just joining in. Initial, comments really from the FOMC. As expected, they've left rates unchanged. A median forecast is now implying that 2 rate hikes will happen this year. Remember, this is versus the 4 that dot plot had suggested. Global economic developments continue to pose a risk is something that the Fed statement has made very clear. They've also said that they still see inflation rising to 2% target over the midterm as transitory effects continue to fade. Punita, let's talk about the India impact then. How do you see our markets sort of react to this tomorrow? I know that there is, of course, Ms. Yellen's press conference that everybody will be listening to, and we'll be wondering whether or not she's going to be hawkish, or will she perhaps strike a sort of cautious note. But given what we've seen from 4 to now 2 hikes in 2016, what does that mean for emerging markets like India?
Well, I wouldn't put all emerging markets in the same category, because I think they're at different stages of growth. Right now, China is slowing. India is likely to accelerate. So I think I wouldn't compare the emerging markets all as a group anymore. But shifting just to India, I think from whatever in the last few minutes, it appears that the markets in the US have reacted positively to this. But that's sort of expected, because it was just a bit of a relief setting in. India, I think, although not insulated from what happens with the Fed hikes, is sort of in its own trajectory for now, at least on the rate cycle, with fiscal deficit being maintained at levels that are comfortable in the current budget. I think, and the RBI inflation sort of coming down a little bit, RBI is likely to potentially cut rates some point down the road, regardless of what the Fed does. So India is going to have a divergent rate cycle for sure. Also, in terms of unemployment, while US is operating at employment levels that are seen as full employment, India, the unemployment is still quite weak, and the economy still needs stimulus. And I think after the budget, the markets have already had somewhat of a relief rally in India. And I think that some of the measures would have potential benefits that will help growth over the next few months. So I think India is actually in a very different economic cycle. And while this news will be seen positively for India, even if the Fed was to hike later on, it might have some effects on the currency markets. But I think in terms of the fundamentals of the Indian economy, I don't think they're going to be hugely impacted by what the Fed does.
Arnab, would you tend to agree with that? Because, you do sort of see EM macro strategy very closely at Invesco. Would you say that what we hear and see the Fed do is not completely, but partially bereft of what the goings on in India are?
Yeah, well, I think I guess I would agree. I would put it a little bit differently. I think India and a number of other emerging market economies are in a position to have this divergent rate cycle from the Fed because their external accounts are significantly insulated from the dollar, because it so happens that they are commodity importers, and because, for depending on the country, for different reasons, they have more credibility perhaps than policy credibility perhaps than they would have had in the past, and might have had to slavishly follow the Fed. because they had a pegged exchange rate regime, or even if they have a floating exchange rate regime because the currency takes a big hit when the dollar strengthens. India's currency, of course, has taken a big hit already, but the dominant feature, I suppose, in the Indian landscape at the moment is that commodity import prices, energy import prices have collapsed. The RBI has a very credible governor and has a much easier time of targeting inflation now. And as was just said, the fiscal part of the picture is much more on side than people had been worried about before the budget. So with that and with inflation under control tending to fall a little bit, and the economy needing some stimulus, it's reasonable to expect the RBI to cut again. Although I guess, taking all things into consideration, the rate cutting process in India and some other emerging market countries that are easing, that rate easing cycle is probably drawing to a close in many different places, not in all by any means, right? And I would say the one that stands out actually in the world is not India, but China, right? China clearly needs more stimulus, clearly needs more monetary easing, and yet it needs to somehow keep shoring up its exchange rate because of the destabilizing effect of any significant pressure on the Chinese currency. If that reemerges, then the fireworks in emerging markets and the risk aversion in the world in general would resume. And I think as we've seen a few times, India, although relatively insulated compared to many other emerging market countries and now a much lower beta country, would not escape unscathed, right? It would be affected through asset prices, equities in particular, and also the currency.
Okay, let's bring in Sharmila Whelan of Asianomics Group into this discussion. Sharmila, I know that you, at least the last time we spoke, had a dramatically different view. You said, hey, you know what, we're going to see no hikes this year. In fact, the Fed's going to be forced to roll back the 25 basis point hike that it took in December. I'm sure you sort of stick by that view, but, at least expectations of a hike from the Fed itself from 4 down to 2. What's your reaction?
Well, Tanya, you're right about us sticking with our call there, and very much more than ever believe that there isn't going to be any other rate hike this year. The fact that the Fed has cut both its inflation forecast as well as its growth forecast for this year is kind of inconsistent with them signaling to the market that they're looking for 2 more rate hikes. And it's inconsistent with what we're seeing out of the data points out of the US. It's sure at the moment it is global concerns that is staying the Fed's hand, but the reality is the U.S. economy itself is slowing pretty quickly. If you look at the manufacturing ISM, it's been below 50 since October last year, so manufacturing is contracting. Industrial production has contracted on a year-on-year basis for the 3 months to January. Retail sales, we saw the numbers this week, which are really weak. Sure, the unemployment numbers, the official unemployment number is low, but the fact remains that, the non-farm payroll, the average for January and February is much slower, is running at about 200,000 versus 284,000 average for the fourth quarter, and average growth in wages is slowing. So to me, there's, if anything, the signs are that the U.S. economy is slowing, and our view is that by mid-year, the U.S. will be in recession, and that in the end is what's going to force the Fed's hand not only to reverse the 25 basis point hike that we've seen. But, our baseline case is that you're going to see QE4 coming in sometime in the second half of the year.
Nandini, I know that, you made the first comment about how risks of a recession are not completely off the table. But would you imagine that in about 15 minutes or so from now, when we hear Ms. Yellen speak, she's going to avoid giving any overly hawkish signals to the market?
No, I think she has to keep a balanced view because, inherently the decision to not raise rates is a dovish stance. She will certainly use those forward guidance terms of saying, there is potential still for rate hikes in the upcoming meetings, maybe not in April, but perhaps in June. And, that they're continuing data dependent and each of the raises will be gradual. So I think that part of her language should still remain there in terms of, keeping a balanced view and still remaining data dependent as her primary task. And I think they will continue to do that. I don't agree that we would necessarily go into recession this year. I think there are risks, and they will certainly be monitoring those. But I do think that the next move from the Fed will be a rate hike rather than a backtracking of the hiking cycle that they've already started.
Punita, where do you stand on this argument? Because the fact remains that the last time we heard Ms. Yellen speak publicly in February, she said that, there were two things that would really decide her next course of action when it came to a rate hike. One would be what the job market was up to. And, if she saw a moderate sort of signs of improvement, that would be good enough. And also the second part would be inflation. Now, many would say that on both counts, things aren't looking so bad. You yourself sitting in Boston, I'm sure, would be able to give us a better sense of, what really the situation on the ground is like. But how much of a probability would you assign to a recession in the US?
I think I'm a little bit more on the bearish camp because I believe the global economy is still quite weak, and the number of tools that central bankers have in Europe and some other countries is very limited because they've exhausted a number of tools to stimulate these economies. And I'm keeping India aside because it's a little bit on a different cycle. So I'm just talking broadly that the global economy remains weak, and there is obviously a big fear of a recession. And I don't think US can be completely insulated from that. So if that happens and the global economy doesn't pick up, US will also slow down. And as a result, what Shalini said is quite. I would assign that a probability of greater than 50%, which is that the U.S. slows down and there is no further rate hike, and even if there is, maybe at most there is one. Of course, the real joker in the pack is what happens to oil prices. And, we are seeing oil prices strengthen, and that somehow, is also giving confidence to equity markets across the world, which are also moving in tandem with rising oil prices, which is actually obviously counterintuitive because long-term higher oil prices are generally not good for the global economy. So if you have rising oil prices and a global economy that's weak, that raises the fear of a recession in certain countries. And I don't think US can be insulated. In fact, it might also bode a bit negative for India if oil prices keep rising. But the positive to rising oil prices is that, right now, while many countries like India benefited from lower imports, they've also seen trade volumes, their exports shrink as well. And a number of global economies are hurting because, all commodity prices have been weak, and so their exports have shrunk. So rising oil prices might mean potentially rising commodity prices for other countries as well. But all in all, I think there is, in my mind, more than a 50% chance that the US could also slow down.
Okay, as we speak, in fact, oil prices, look at US crude up something like 5%, Brent not far behind, also notching higher by a good 4%. Arnab, come in on that and talk to us about, the risks of US going into recession. Is that something that you've sort of factored in as well? Both, at least Shalini and Punita, seem pretty bearish. Is that a view that you would share as well?
No, I think our view of it is, there is, of course, always some risk of a recession in the U.S. and other countries. But our take is that recession risk is fairly low at this point. That risk would go up significantly if there were, as has happened from time to time, if there were sustained a significant tightening in financial conditions through the dollar and through the instability we think emanating ultimately from China and the risk of a deflationary shock. And I think that, that's a large part of what we've seen play out in the oil market. Of course, there are supply factors as well. But that deflationary shock and earlier on the deflationary pressures emanating from the Eurozone and from Japan as well had come together and create a lot of financial tightening. That has eased off in the last month, and the Fed's let's say, dovishness relative to fears, if not expectations today, has helped alleviate that problem. And I think that's why we're seeing a sort of contemporaneous weakening in the dollar and a rise in the oil price. Right? It's not that the fundamentals of the oversupply in the oil market or the underlying issue of an aggregate demand shortfall in the world are being corrected today right at the same time as the Fed is speaking. I think what had happened is that the market had gotten relatively bulled up after the stabilization in China, and then had taken a bit of a reflective pause and a correction in advance of the FOMC and the testimony, concerned that the Fed might try to guide the market closer to the original dot plot, which would imply a continuation of the strong dollar and the dollar shock in the rest of the world. Instead, the Fed has sort of, like I said before, has met the market at least halfway, and then depending on where the data goes, we might go down from 2 hikes to 1. But we don't think that there's that kind of recession pressure. It's true that parts of the manufacturing sector and certain states, particularly the new oil states and some of the old oil states in the United States, are themselves in recession. But I think it's important to remember that a supermajority of the U.S. economy is not about manufacturing. It's not about energy. It's about mom-and-pop stores and small and medium enterprises, and about consumption and a labor market that continues to tighten, albeit without much wage pressure, much inflation pressure. It seems pretty clear that the output gap is narrowing because, not least because productivity growth is slowing down significantly. So the Fed has a tight course here to navigate in. Our take on it is that there's probably going to be one more hike, maybe 2, but there's probably not going to be a recession just yet in the U.S. So that's I think what that's probably pretty close to what the market is interpreting from the Fed and interpreting from the data at the moment. Now that the Fed has proven to be, let's say, has sort of steered that course and come out with a relatively dovish way of pointing to two more rate hikes. And that's why it seems like we're back on in a bit of a risk-on environment again.
Mm-hmm. Okay, and the dollar index is down as we speak, but that I suppose was more or less expected. But let's get a word in from Priya Misra, who's the head of global rate strategy at TD Securities. She's of course on the phone line with us from New York. Priya, let's talk about what the FOMC statement really means for the dollar now. It's of course down, and that's not surprising. But going ahead, what's the outlook on the currency, you think, given that we're now looking at least 2 probable hikes?
Right. I think what is clear from the statement is that the threshold to hike here is much higher than what the market was thinking. So I think we're going to need strong data. We're also going to, from the U.S. for the dollar to strengthen. But we are also going to need stronger global developments. We need financial conditions to actually hang in there, because now the Fed's kind of telling you that they have 3 mandates. They have the employment mandate, the inflation mandate, and this financial conditions mandate, and they need stability in that in that variable as well. So we are longer term bullish the dollar, but I think our conviction level would be lower because the Fed is signaling through the statement today. They actually had a perfect chance to just sort of punt today and say they keep every meeting live. But by putting in the statement that they've gone from assessing financial developments to actually stating that it poses risks, and we know where the risks are. They're downside risks. They're telling you that they need to be convinced to hike again. Now, I know that the dot plot suggests 2 hikes, but the problem is we've got Brexit in June, or at least the risk of Brexit in June. So it makes June a little bit harder. Are we talking, July, September? We're getting close to the election. So you're going to find investors who had been positioning for 2 rate hikes this year to start pushing it really to the end of the year, which is why, and that's going to drive the dollar as well. So I think for the dollar bulls, you may have to be a little more patient, because you need to actually not just look for strong U.S. data, which I think we are getting, but even stronger global developments.
Sure. Sharmila, let's talk about what we can hear Ms. Yellen say in the next 6 minutes or so. To a large extent, wouldn't you agree if I said that, there's also a bit of a credibility at stake? I mean, no one can forget the 2015 saga of will she, won't she? So do you think that this time round, this is her first big press conference this year, she's, perhaps going to hit far more directly and be clear, or is she going to leave us guessing?
I think she's just going to make very neon signals that all is well in the U.S. economy, and kind of soft touch and signal the rate hikes that she's talking about. But that's global financial markets are tetchy enough. There are concerns about the global economy and where it's headed, and I don't think she wants to rock the boat. So I think it's going to be more assurances and a soft touch on the outlook for the U.S. economy, outlook for monetary policy.
Okay, we seem
but,
to have...
I think she'll be singing a very different tune. Expect the U.S. starts slowing very, very quickly and goes into recession. And I think you'll see a reversal very quickly. Okay, that means it's going to be a complete, a big loss of face. But in an election year, they can't be handing over to the next president coming into power in January next year. Here you go. Here's another recession for you.
I think Sharmila is convinced that we're going to see a recession this year in the US. But Punita, since Sharmila also talked about the elections, and I think that is something that there's no denying that there's been so much noise and rhetoric about it. How do you see that play out? Because would you say that somewhere, we're looking at the US with rose-tinted glasses, because it's seeming like economically, at least when you hear Hillary Clinton and Donald Trump, all seems to be well?
I think, first of all, I think everybody, it appears to me that, whoever I speak to in the US is quite concerned about this election, because the general view is that they don't feel compelled by any of the candidates that are in the lead right now. So there is a general concern about the election. There's also a general view that both the candidates are not necessarily going to be good for financial markets. So that's the second view that is sort of around prevailing right now. And then the third is that this is just based on historic data, that if you look at election years in the past history of the US markets, election years, strangely enough, have always boded well for equity markets. Now, I don't know what to make of that, but generally election years, the markets tend to do well, and it's only post the elections that all the concerns start emerging and the markets take a different trend, whether it's on concerns or depending on who the president is. So I think the next few months probably seem okay based on everything, all the data that's out there, and no Fed rate hike. But yes, there is general concern about this election, and nobody's really got strong views on any candidates as to who's going to be whether either of them are going to be necessarily good for financial markets.
Mm-hmm. Okay. 2 minutes to go for that press conference. Nandini, a quick word on what you will be, sort of looking out for. How should one be sort of positioning themselves now, say in the short term, given what we've heard from at least the FOMC statement and, of course, post Ms. Yellen's statement?
Sure. I think the biggest thing for her statement is understanding what other aspects of the market and economy she's monitoring. I think financial conditions, we've talked a lot about in this program already today, are ones that I'll be looking at closely. But in general, I think the risks are higher to some of that slowdown that we've talked about than they were before. So seeing, is the labor market expanding in the way it needs to? Is wage growth coming through in the next several labor market reports? Is there going to be that inflationary pressure that the Fed is waiting to see in the next few months finally building up? Those are the things I'll be looking at. And then, of course, how the economy and the stock market does react to some of her language after today, although I think most of it's already been baked into market activity that we've seen.
Priya, what about you? Anything that you will specifically suggest one keeps, sort of ear and eye out for?
from Yellen in a little bit. Sorry, did you mean just from
her press conference? We have from her press conference.
Yeah. I think, if she stresses on the fact that there are 9 members that are still looking for 2 hikes this year, she continues to say that every meeting is live. I think she can try and take a little bit of the market off. We've had a very sharp reaction, 10 basis points lower rates in the front end of the curve. I'm sure she's looking at the market reaction. And she might remember what happened in September, which is when the Fed came out with a very dovish statement. The equity market actually took it to be a very negative signal. What does the Fed know that we don't know? Why is the Fed sounding that dovish? So I actually think she's going to try and, calm us down a little bit and say, well, we haven't said that we can't hike and we're still waiting and watching and every meeting's live. I think if she stresses on that, you can see the market take back a little bit of this extreme reaction. Because right now it does seem as if, it's not even clear that they can get 2 hikes. And the market's always been below the dots. So to some extent, if the Fed's telling us 2 dots, maybe the market should be pricing in no more hikes this year. I think that's the fear right now, which is why rates are reacting and the dollar is reacting as much. So we need her to now try and push back again.
All right, Priya, we'll leave it at that because we're going to cut across to that press
conference. 1/4 to 1/2%. Our decision to keep this accommodative policy stance reflects both our assessment of the economic outlook and the risks associated with that outlook. The committee's baseline expectations for economic activity, the labor market, and inflation have not changed much since December. With appropriate monetary policy, we continue to expect moderate economic growth, further labor market improvement, and a return of inflation to our 2% objective in 2 to 3 years. However, global economic and financial developments continue to pose risks. Against this backdrop, the committee judged it prudent to maintain the current policy stance at today's meeting. I will come back to our policy decision momentarily, but first let me review recent economic developments and the outlook. The labor market continues to strengthen. Over the most recent 3 months, job gains averaged nearly 230,000 per month, similar to the pace experienced over the past year. The unemployment rate was 4.9% in the first 2 months of the year, about in line with the median of FOMC participants' estimates of its longer-run normal level. A broader measure of unemployment that includes individuals who want and are available to work, but have not actively searched recently, and people who are working part-time but would rather work full-time, has continued to improve. Of note, the labor force participation rate has turned up noticeably since the fall, with more people working or actively looking for work as the prospects for finding jobs have improved. But there's still room for improvement. Involuntary part-time employment remains somewhat elevated, and wage growth is yet to show a sustained pickup. The improvement in employment conditions so far this year has occurred as economic growth appears to have picked up from the modest pace seen in the fourth quarter of last year. Household spending is expanding at a moderate rate, supported by continued job gains and increases in inflation-adjusted incomes. In contrast, business investment has been weak, in part reflecting further reductions in oil drilling as a result of low oil prices. Net exports also remain soft as a consequence of subdued foreign growth and the earlier appreciation of the dollar. Looking ahead, the committee expects that with gradual adjustments in the stance of monetary policy, economic activity will continue to expand at a moderate pace and labor market indicators will continue to strengthen. Ongoing economic growth and additional strengthening in labor market conditions are important factors underpinning the inflation outlook. Overall consumer price inflation, as measured by the price index for personal consumption expenditures, stepped up to 1.25% over the 12 months ending in January, as the sharp decline in energy prices around the end of 2014 dropped out of the year-over-year figures. Core inflation, which excludes energy and food prices, has also picked up, although it remains to be seen if this firming will be sustained. In particular, the earlier declines in energy prices and appreciation of the dollar could well continue to weigh on overall consumer prices. But once these transitory influences fade, and as the labor market strengthens further, the committee expects inflation to rise to 2% over the next 2 to 3 years. The committee's inflation outlook rests importantly on its judgment that longer-run inflation expectations remain reasonably well anchored. However, the stability of longer-run inflation expectations cannot be taken for granted. Survey-based measures of longer-run inflation expectations are little changed on balance in recent months, although some remain near historically low levels. Market-based measures of inflation compensation also remain low. Movements in these indicators reflect many factors, and therefore may not provide an accurate reading on changes in the inflation expectations that are most relevant for wage and price setting. Nonetheless, our statement continues to emphasize that in considering future policy decisions, we will carefully monitor actual and expected progress toward our inflation goal. This general assessment of the outlook is reflected in the individual economic projections submitted for this meeting by FOMC participants. As always, each participant's projections are conditioned on his or her own view of appropriate monetary policy, which in turn depends on each person's assessment of the multitude of factors that shape the outlook. Participants' projections for growth of inflation-adjusted gross domestic product, or GDP, are just a touch lower than the projections made in conjunction with the December FOMC meeting. The median growth projection edges down from 2.2% this year to 2% in 2018, in line with its estimated longer-run rate. The median projection for the unemployment rate falls from 4.7 at the end of this year to 4.5% at the end of 2018, somewhat below the median assessment of the longer-run normal unemployment rate. The median path of the unemployment rate is a little lower than in December, in part reflecting a slightly lower median estimate of the longer-run normal unemployment rate. Finally, with the transitory factors holding down inflation expected to abate and labor market conditions anticipated to strengthen further, the median inflation projection rises from 1.2% this year to 1.9% next year and 2% in 2018. The median inflation projection for this year is a little lower than in December, but thereafter the median projections are unchanged. Since the turn of the year, concerns about global economic prospects have led to increased financial market volatility and somewhat tighter financial conditions in the United States, although financial conditions have improved notably more recently. In addition, economic growth abroad appears to be running at a somewhat softer pace than previously expected. These unanticipated developments, however, have not resulted in material changes to the committee's baseline outlook. One reason for this is that market expectations for the path of policy interest rates have moved down, and the accompanying decline in longer-term interest rates should help cushion any possible adverse effects on domestic economic activity. Indeed, while stock prices have fallen slightly since the December meeting, and spreads of investment-grade corporate bond yields over those on comparable maturity Treasury securities have risen, mortgage rates and corporate borrowing costs have moved lower. Of course, the committee will continue to monitor these developments closely and will adjust the stance of monetary policy as needed to foster our goals of maximum employment and 2% inflation. Returning to monetary policy, as I noted earlier, the committee decided to maintain its target range for the federal funds rate. This decision partly reflects the implications for the U.S. economy of the global economic and financial developments I just mentioned. In addition, proceeding cautiously in removing policy accommodation at this time will allow us to verify that the labor market is continuing to strengthen despite the risks from abroad. Such caution is appropriate given that short-term interest rates are still near zero, which means that monetary policy has greater scope to respond to upside than to downside changes in the outlook. As we indicated in our statement, the committee expects that economic conditions will evolve in a manner that will warrant only gradual increases in the federal funds rate. The federal funds rate is likely to remain for some time below levels that are expected to prevail in the longer run. This expectation is consistent with the view that the neutral nominal federal funds rate, defined as the value of the federal funds rate that would be neither expansionary nor contractionary if the economy was operating near potential, is currently low by historical standards and is likely to rise only gradually over time. The low level of the neutral federal funds rate may be partially attributable to a range of persistent economic headwinds that weigh on aggregate demand, including developments abroad, a subdued pace of household formation, and meager productivity growth. There is considerable uncertainty regarding the evolution of the neutral funds rate over time. However, if these headwinds abate as we expect, the neutral federal funds rate should gradually move higher as well. This view is implicitly reflected in participants' projections of appropriate monetary policy. The median projection for the federal funds rate rises only gradually to 0.9% late this year and 1.9% next year. As the factors restraining economic growth are projected to fade further over time, the median rate rises to 3% by the end of 2018, close to its longer-run normal level. Compared with the projections made in December, the median path is about 0.5 percentage point lower this year and next. The median longer-run normal federal funds rate has been revised down as well. In other words, most committee participants now expect that achieving economic outcomes similar to those anticipated in December will likely require a somewhat lower path for policy interest rates than foreseen at that time. I would like to underscore, however, that the participants' projections for the federal funds rate, including the median path, are not a plan for future policy. Policy is not on a preset course. These forecasts represent participants' individual assessments of what appropriate policy would be given each person's own current projections of the most likely outcomes for economic growth, employment, inflation, and other factors. However, considerable uncertainty attaches to each participant's forecasts of economic outcomes. Hence, their assessments of appropriate policy are also uncertain and will change in response to adjustments to the economic outlook and associated risks, as was the case between December and now. Also, it's important to note that the committee makes its decisions on a meeting-by-meeting basis and does not and need not decide on a likely future path for the federal funds rate. Indeed, the future path of policy is necessarily uncertain. because the economy will surely evolve in unexpected ways. As we note in our statement, the actual path of the federal funds rate will depend on the economic outlook as informed by incoming data. Finally, the committee will continue its policy of reinvesting proceeds from maturing Treasury securities and principal payments from agency debt and mortgage-backed securities. As highlighted in our policy statement, we anticipate continuing this policy until normalization of the level of the federal funds rate is well underway. Maintaining our sizable holdings of longer-term securities should help maintain accommodative financial conditions and should reduce the risk that we might have to lower the federal funds rate to zero in the event of a future large adverse shock. Thank you, and I'll be happy to take your questions.
Steve Leisman, CNBC. Madam Chair, as you know, inflation has gone up the last 2 months. We had another strong jobs report. The tracking forecast for GDP have returned to 2%, and yet the Fed stands pat while it's in a process of what it said it launched in December was a process of normalization. So I have two questions about this. Does the Fed have a credibility problem in the sense that it says it will do one thing under certain conditions but doesn't end up doing it? And then, frankly, if the current conditions are not sufficient for the Fed to raise rates, well, what would those conditions ever look like?
Well, let me start with the question of the Fed's credibility. And you use the word promises in connection with that. And as I tried to emphasize in my opening statement, the paths that the participants project for the federal funds rate and how it will evolve are not a preset plan or commitment or promise of the committee. Indeed, they are not even, the median should not be interpreted as a committee-endorsed forecast. And there's a lot of uncertainty around each participant's projection, and they will evolve. Those assessments of appropriate policy are completely contingent on each participant's forecasts of the economy and how economic events will unfold. And they are, of course, uncertain, and you should fully expect that forecasts for the appropriate path of policy on the part of all participants will evolve over time as shocks, positive or negative, hit the economy that alter those forecasts. So you have seen a shift this time in most participants' assessments of the appropriate path for policy. And as I tried to indicate, I think that largely reflects a somewhat slower projected path for global growth, for growth in the global economy outside the United States, and for some tightening in credit conditions in the form of an increase in spreads. And those changes in financial conditions and in the path of the global economy have induced changes in the assessment of individual participants in what path is appropriate to achieve our objectives. So that's what you see. That's what you see. Now, I guess you asked me also, what would we need to see to continue raising rates? And I think it's worth pointing out here that the committee, most participants do continue to envision that if economic developments unfold as they expect, that further increases in the federal funds rate will prove appropriate over time. Most participants anticipate that. And that the pace will be gradual. As I emphasized, most empirical work attempting to assess what the equilibrium level of the Fed funds rate is, a level that would be neither expansionary nor contractionary, those assessments are quite low at this time. So there is accommodation in the stance of policy, and we do expect over time that neutral rate to move up, but we're not positive what the pace of change of that will be over time. But given that the economy is now close to our maximum employment objective, hopefully inflation is moving up. As you mentioned, recent readings on inflation have moved up. There may be some I want to warn that there may be some transitory factors that are influencing that, but certainly our projections are for a gradual increase in inflation, and the committee, at least most participants, continue to expect that if we follow along this course, that some further adjustments in the federal funds rate will be appropriate but gradual.
Sam Fleming from the Financial Times. Could I just follow up on this inflation point? Because the numbers have been ticking up, as you said, somewhat at least. And we're also, as you said, also at a point where we have a quite close to full employment. Is there a risk that we're heading for an overshoot in inflation? And is there, given the greater symmetry the Fed has been flagging up in terms of its inflation target, a greater tolerance for a modest overshoot, especially given the long period of undershoots that we've been through?
So I want to make clear that our inflation objective is 2%, and we are projecting a move back to 2%, and we are not trying to engineer an overshoot of inflation, not to compensate for past undershoots. So 2% is our objective, but it is a symmetric objective. And we certainly don't seek to overshoot our objective, but some undershoots and overshoots are part of how the economy operates, and our tolerance for those is symmetric with respect to under and overshoots. We did take note in the statement of the fact that inflation has picked up in recent months. I see some of that as having to do with unusually high inflation readings in categories that tend to be quite volatile without very much significance for inflation over time. So I'm wary and haven't yet concluded that we have seen any significant uptick that will be lasting in, for example, in core inflation. But we note, the committee notes, as it did in December, that we continue to monitor development trends and developments closely. And that would include both the fact that recent inflation readings have been on the high side, and as I mentioned on the other side, that readings on measures of inflation compensation and some survey measures have been on the low side. So in that sense, there are risks around the inflation forecast in both directions.
Lindsay, and then. Hi, Lindsay Dunsmuir with Reuters. Your statement did note that, as you're saying, that inflation has picked up in recent months, and you do still see it going back to 2% over the medium term. Yet policymakers have downgraded GDP growth forecasts for this year and one of the inflation measures. So that to me would indicate a weakening economic environment, and I'm wondering how in that environment you justify the possibility of 2 rate hikes this year.
So there has been a slight downgrading of the assessment of economic growth for this year, but nevertheless growth is expected to run somewhat in excess of potential, so that the labor market is expected to continue to tighten, and by the end of the year even edge below levels of the unemployment rate that are estimated to be longer in the normal run. And inflation is expected to gradually move back to 2% over time. We still have, weighing on inflation, the influence of earlier declines in energy prices and a prolonged effect from the appreciation of the dollar. But we do expect those transitory influences to fade, and with a continuing improvement in the labor market, I think we'll see upward pressure on inflation. And in that context, the committee sees it appropriate to, if things unfold in that way, to have some further increases in the federal funds rate. It remains accommodative. As I indicated in December, the committee indicated in December, we want inflation to go back to 2%, but we also want to be careful not to see some significant overshoot so that we would get behind the curve and potentially be faced with a need to tighten in a very rapid fashion later in a way that could undermine the sustainability of the employment gains we've had. But we do see some continued tightening in monetary policy to be appropriate in that event.
Chair Yellen over here. Hi, Peter Barnes with Fox Business. Could you get a little bit more specific about the global and economic financial developments that continue to pose risks to the U.S. economy? You just did mention the strong dollar there just a second ago and slowing global growth, but are you specifically concerned about, for example, China, the emerging markets, and the EU? Could you expand on the risks?
So there has been, by many forecasters, slight downgrading of forecasts of global growth over the coming several years. The IMF has slightly downgraded their forecasts, and other international agencies have as well. Chinese growth hasn't proven a great surprise. We've anticipated that it would slow over time, and it seems to be slowing as well. Japanese growth in the fourth quarter was negative, and that was something of a surprise. And with respect to the euro area, recent indicators suggest perhaps slightly weaker growth. So there's been a number of emerging markets, as you know, were suffering under the weight of declines in oil prices that are affecting their economic activity. Our neighbors, both to the north and south, Canada and Mexico, are feeling the impacts of lower oil prices on their growth. So our projection for global growth for those reasons is slightly lower, not dramatically lower, but enough lower to make some difference to our forecast. And as I indicated, I think that's part of the reason, along with the associated increase we have seen in some spreads that are involved in enter into corporate borrowing rates and can affect investment decisions. It's a reason to think that a slightly lower path for the federal funds rate will be appropriate to achieve our objectives. And so what you see here is a virtually unchanged path of economic projections and a slightly more accommodative path that most participants are writing down for what's necessary to achieve that.
Kate, and then Steve Muffson.
Thank you. Kate Davidson from the Wall Street Journal. Madam Chair, you've emphasized repeatedly that every meeting of the FOMC is a live meeting. You have a meeting next month. Is it possible that you could get enough information between now and then to get you comfortable with raising rates again in April, and what would you need to see?
So I will say again that every meeting is a live meeting. April remains a live meeting, and we will be tracking incoming data. It's a slightly shorter period. We have 6 weeks, but there will be additional data on the labor market and on various factors that pertain to inflation. So that is certainly a live possibility.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.